Here's the crazy thing about real estate in 2025. Even with higher prices and higher rates, there are still cities in America where you can buy homes for under $250,000 and still pull double-digit rent growth. Yeah, I know, that sounds impossible, right? But the smart money already knows where those deals are hiding. Today, we're breaking down the most undervalued US markets where investors are quietly scooping up property while everyone else is frozen by the cooling market headlines. Before we dive in, hit like, subscribe, and drop a comment below. Tell me which city you think still has big upside in 2025. Every click helps this channel grow and keeps these deep dive housing videos coming your way. Finding real estate deals in 2025 feels like trying to find shade in the desert. Prices exploded, inventory's still tight, and many people think the window closed. But it didn't close, it moved. The deals didn't disappear, they relocated. Big coastal markets like San Francisco, LA, and New York cooled off, but that doesn't mean the game's over. It means smart investors shifted to secondary metros where homes are still affordable, rent yields are stronger, and appreciation potential is real. Here's what blew my mind. The best performing investor markets right now aren't on the coasts. They're in cities you'd never expect. Indianapolis, Birmingham, Kansas City, places where investors are pulling six-figure profits on deals most people ignore. So if you've been waiting for the right time, this is your wake-up call. While everyone else waits for rates to drop, the smart buyers are planting flags in America's next growth cities. Let's start in the Midwest, still the unsung hero of US real estate. You can find three-bedroom homes in Indianapolis, Columbus, or Kansas City for under $275,000, less than half the national median. Rent-to-price ratios hover between 0.8 and 1% per month, which means $1,800 rent on a $220,000 home is totally doable. Job growth is solid. Logistics, healthcare, and manufacturing are expanding again. Although these markets may seem unexciting, their stability is appealing when your tenants consistently cover the mortgage each month. And it's not just those big metropolises. Des Moines, Iowa, and Omaha, Nebraska have become quiet investor favorites. Steady population inflow, good schools, low vacancy rates, and property taxes that don't eat your returns. If you're getting value from this list so far, tap like and tell me your favorite Midwest market down in the comments. Next stop, the Southeast United States. Population growth here is relentless, and affordability still beats the national average. Birmingham, Alabama, and Raleigh, North Carolina continue to attract buyers fleeing expensive coastal states. Birmingham's median sits near $245,000 with rents climbing 8 to 10% annually. Raleigh's tech and medical sectors are booming, and its inbound migration keeps prices firm. Add Chattanooga, Tennessee, and Greenville, South Carolina to your watch list. Both offer small city charm with big city job creation, and investors are picking up duplexes and starter homes that still cash flow on day one. That's rare in 2025. Here's something most investors miss. The Sun Belt isn't done, it's evolving. San Antonio, Texas, and Tampa, Florida are examples of markets that grew fast, corrected slightly, then found equilibrium. Prices are stable, new construction is matching population growth, and employment diversity keeps demand healthy. Oklahoma City is another hidden gem. Median home price around $230K, strong aerospace and energy sectors, and rental yields near 1% per month. If you've been waiting for a sign to move on to one of these markets, consider this it. Opportunities are still here, just not where mainstream headlines tell you to look. And speaking of opportunity, a quick word from the sponsor that helps keep this channel alive. This episode is brought to you by New Silver, the lender built for real estate investors who need fast, reliable financing. Whether you're flipping houses or building a rental portfolio, New Silver offers fix and flip and rental loans with lightning-fast approvals and flexible terms. In markets like San Antonio or Kansas City, state of Missouri, speed is everything. That's your competitive edge. If you're serious about investing this year, check out New Silver, the first link in the description. Supporting them supports this channel and helps me keep bringing you these data-driven market breakdowns every week. Now let's head west. The mountain states are having a quiet comeback. After the pandemic boom, Boise, Idaho, and Salt Lake City, Utah corrected hard, down nearly 10% between 2022 and 2023, but they're bouncing back fast. Boise's median sits around 450K, still below its peak, but rising again thanks to tech and logistics jobs. Salt Lake City's affordability improved enough to bring first-time buyers back in. Don't forget to hit like if you're getting value and share your favorite Western market in the comments. I read them all. Currently, there is an area that most investors overlook, the Rust Belt revival. Cities like Cleveland, Ohio, Pittsburgh, Pennsylvania, and Detroit, Michigan have quietly turned into investor magnets. Median prices under $230,000, revived downtowns, and emerging tech and medical campuses are creating real jobs. You're not chasing hype here, you're buying yield and stability. What connects all these regions? Affordability, job diversity, and migration inflow. None rely on speculation, they rely on fundamentals. That's why they're resilient, and why they're still the best real estate deals left in 2025. Let's zoom out for a second and talk about why these markets work when others stall. It comes down to three pillars: affordability, job growth, and migration. When two of those three line up, prices stay stable. When all three align, you get appreciation and cash flow at the same time. That's exactly what's happening across much of the Midwest and Southeast right now. 2025 is turning into the year of balanced returns. You're not doubling equity overnight, but you're locking in solid rent yields with less competition and less risk. For investors who actually want to build wealth instead of gamble, this decade is the sweet spot. So how do the pros find these cities early? They follow data that most people ignore: U-Haul migration trends, new construction permits, and major employer announcements. When a metro area adds logistics centers, hospitals, or tech parks while maintaining median prices below the national average, it signals a promising opportunity. Let's look at a few more examples that fit that formula. Spokane, Washington quietly became a favorite for investors priced out of Seattle. Median home price sits around $380,000, rent growth is 7%, and cap rates are over 6%. Chattanooga, Tennessee, which we mentioned earlier, is now pulling remote workers from Atlanta because it's cheaper and still has fiber optic internet citywide. Columbus, Ohio is booming from Intel's semiconductor project, thousands of jobs, population inflow, and homes still under $300,000. If you're enjoying these insights, hit like and make sure you're subscribed. This channel's all about spotting those signals before they hit the headlines. Now, investor psychology, the part few people talk about. The most common mistake made by new investors in a cooling market is anticipating a potential crash that never occurs. Real estate doesn't collapse everywhere at once, it rotates. The key is to move with the rotation. When the coasts slow down, the heartland continues to thrive. When luxury hesitates, affordable housing thrives. That's the rhythm of American real estate. Experienced investors use that rhythm. They're not emotional, they're analytical. They know that a 6% mortgage rate doesn't kill a deal if the rent yield is 9%. They know markets move in cycles, and they build portfolios that survive every phase. You want to think the same way: diversify locations, focus on rent coverage, and keep cash reserves for flexibility. Another tip: track infrastructure spending. Wherever the government and major corporations invest billions in highways, ports, airports, and industrial parks, housing demand follows. It's happening in Savannah, Georgia, Tulsa, Oklahoma, and Boise, Idaho right now. Let's pivot to property types for a minute. Single-family rentals still dominate, but the quiet winners of 2025 are small multifamily and build-to-rent communities. These offer scalability without corporate-level competition. In markets like Raleigh, Indianapolis, and Tampa, duplex and triplex deals still generate 7 to 8% cash-on-cash returns if financed right. And remember, you don't need to live in these markets to invest there. Technology changed everything. Virtual tours, remote management, and lenders like New Silver that work nationwide make it easier than ever to buy where the numbers work instead of where you happen to live. Now, speaking of financing, a quick reminder from today's sponsor. This video is powered by New Silver, the tech-driven lender built for investors who need speed and flexibility. They offer fix and flip and rental loans with simple online applications and quick closings. Whether you're buying your first rental in Cleveland or your fifth flip in Tampa, having New Silver in your corner means you can move fast when opportunity strikes. The link's right there in the description. Check them out, and by supporting New Silver, you're supporting this channel. helping me keep these deep dive market videos coming every week. All right, let's talk about emerging trends that are shaping where the next wave of deals will be. One big one, adaptive reuse, converting old commercial spaces into housing. Cities like Pittsburgh, St. Louis, and Denver are giving tax breaks for developers who transform empty offices into apartments. This creates opportunities for investors who are eager to collaborate or take part in smaller-scale conversion projects. Another trend, secondary vacation markets. With remote work here to stay, places within 2 or 3 hours of major metros, think Asheville, North Carolina, Bend, Oregon, and Traverse City, Michigan, is pulling in both tourists and permanent residents. Short-term rental regulations are stricter now, but if you focus on mid-term stays, nurses, contractors, digital nomads, the returns can beat long-term rentals by 20 to 30%. Don't forget about build-to-rent subdivisions. In 2025, builders aren't just selling homes, they're holding entire neighborhoods as rental portfolios. That signals institutional confidence in markets like Phoenix suburbs, Houston outskirts, and Jacksonville. Follow that money trail. If this is helping you think differently about where the real opportunities are, tap that like button and share this video with someone who keeps saying, there are no deals left. Now, let's address one big misconception, that you can't make money because rates are high. Here's the truth. Cash flow is about spread, not rate. If rent rises faster than interest cost, your spread widens. That's happening in markets where wage growth is strong but home prices have stayed moderate. That's precisely why places like Indianapolis and Raleigh keep outperforming. And let's be honest, waiting for rates to fall is like waiting for permission to succeed. The investors who act now will refinance later. Those who wait will end up chasing higher prices when the crowd floods back in. So the question isn't, are there any deals left? It says, are you ready when the next opportunity crosses your screen? All right, let's start pulling this together. The Midwest and Rust Belt give you affordable entry and stable rent returns. The Southeast offers migration momentum and new industry growth. The Sun Belt is rebalancing into long-term sustainability. The mountain states are regaining traction after their correction. Together, these regions represent the backbone of American housing resilience. If you're still watching, you're part of the smart crowd that actually wants to understand the market, not just react to it. Do me a favor, subscribe, like, and drop a comment with the city you're most bullish on right now. Let's bring everything together and talk about what really separates the investors who win in this market from Theons, still waiting on the sidelines. Because in 2025, real estate isn't about chasing hype anymore. It's about understanding patterns. The winners read data like a map. They know when migration accelerates, job growth follows. When job growth hits, rental demand rises. And when rental demand rises, values follow. That's the sequence. It's predictable if you're paying attention. You don't need insider access, you need discipline. Every month, I tell investors the same thing. Track population shifts, follow employment announcements, and watch building permits. If a city's adding 10,000 residents a year but only building 2,000 homes, you found a supply gap. That's your cue. Those are the markets that compound quietly before the crowd arrives. Now, let's go back to the Midwest for a second because this region is getting more diverse than people realize. Columbus, Cincinnati, Indianapolis, Des Moines, and Omaha, they're all investing heavily in infrastructure. Columbus has Intel's massive semiconductor complex, Omaha's tech corridor is expanding, and Indianapolis just approved billions in logistics upgrades tied to Amazon and FedEx. These aren't flyover towns anymore, they're value engines. You buy early, you hold, and you let economic gravity do its work. Meanwhile, the Southeast is transforming the migration landscape. Florida isn't just for retirees anymore. It's for remote tech workers, entrepreneurs, and families chasing lower taxes and better weather. Cities like Tampa, Jacksonville, and Sarasota are balancing growth without overheating. Georgia's corridor from Savannah to Atlanta is exploding with distribution and manufacturing jobs. Don't overlook Huntsville, Alabama. As NASA's projects there are attracting engineers and defense contractors, providing significant income stability for landlords. In the Sun Belt, most people focus on Texas and Arizona, but let's delve deeper. Oklahoma City, El Paso, Corpus Christi, and even Baton Rouge are drawing investors who got priced out of Austin or Dallas. you can still find 200K single-family homes with strong rent potential and minimal competition. You're not bidding against 10 hedge funds here. You're dealing with real people, real sellers, and real numbers that make sense. Now, the mountain states, this is where affordability meets quality of life. After the 2021-2022 frenzy, cities like Boise and Salt Lake City cooled, but never crashed. Why? Because migration from California didn't stop, it just normalized. A lot of those families stayed, bought homes, and started businesses. Add in states like Montana and Colorado, where secondary markets like Missoula and Colorado Springs are booming, and you've got real diversification. Lastly, the Rust Belt revival is undeniably the most underappreciated region of them all. Cleveland, Pittsburgh, Detroit, Buffalo, these markets are sitting on decades of undervaluation. Renovation incentives, historic tax credits, and adaptive reuse projects are drawing in both local and out-of-state investors. And when you can buy a 4-unit building for what a 1-bedroom condo costs in Miami, your downside risk is practically built out of the deal. If you find this breakdown useful, please take a moment to hit the like button. It informs YouTube that this content is valuable and helps us reach more serious investors like you. Now let's talk about investor mindset. The truth is, most people lose money in real estate not because they pick bad properties, but because they pick bad strategies. They speculate instead of analyze. They react emotionally instead of planning logically. The year 2025 presents an opportunity to change this approach. Start thinking like an operator, not a gambler. Operators run numbers backward. They begin with the end in mind. They know the exit strategy before they buy. Ask yourself, is this investment a flip, a long-term hold, or a hybrid? What's your cash-on-cash return target? What's your plan if rents flatten? You'd be amazed how many investors can't answer those questions and wonder why they struggle. And remember, in today's market, speed equals opportunity. That's why working with lenders who understand investors like New Silver matters more than ever. Whether you're chasing a short rehab window or trying to build out a portfolio, being able to move quickly when a deal hits your inbox is the difference between locking in profit and watching it disappear. Check out the first link in the description. It's your shortcut to faster funding and smoother closings. All right, back to strategy. I want to leave you with a simple framework that I use and teach. Locate, evaluate, execute. Locate the markets where data, not emotion, tells you people are moving. Evaluate deals with conservative numbers, not best-case scenarios. And execute with confidence once the math works. Let's put it in context. You locate Columbus because job growth is double the national average. You evaluate a duplex that rents for $2,800 with 1,600 pity. You execute. Lock financing, close fast, manage efficiently. That's not speculation. That's calculated wealth building. And here's the kicker. The best deals often happen when everyone else is scared. Warren Buffett says, "Be fearful when others are greedy, and greedy when others are fearful." 2025 is a fearful phase for many. Inventory is tight, but sentiment is low. That's the moment when the patient investor wins. Before we wrap, let's touch on the long view. The US housing shortage hasn't gone away. We're still millions of units short, and construction costs aren't dropping anytime soon. That means rents will stay supported even if prices wobble. That's why owning real assets still beats holding cash that loses value every year. Now, if you've watched this far, I want to personally thank you. You're part of the few who care about education over hype. You're not chasing viral trends. You're building knowledge and power through information. So here's my challenge. Find one market from this video that caught your attention. Research it. Look at migration data, rent growth, and employment trends. Run the numbers on a real deal this week. Even if you don't buy it, practice the analysis. That's how confidence grows, through repetition. All right, let's land this plane. The Midwest and Rust Belt deliver affordability and consistent returns. The Southeast is a region where migration and new job opportunities align with an appealing lifestyle. The Sun Belt continues to mature into a rental powerhouse. The Mountain States offer lifestyle demand with renewed affordability. These are your 2025 opportunity zones. If you took value from this, hit like, subscribe, and comment on which of these regions you're planning to invest in. I read everyone, and your insights help shape future videos. Remember, opportunity doesn't disappear, it relocates. 2025 isn't the end of the housing boom, it's the evolution of it. Stay informed, stay adaptable, and keep building your foundation while others sit on the sidelines. And if you're ready to start investing smarter, not harder, check out our sponsor New Silver using the link below. Fast loans, simple terms, and a team that understands investors like us. I'm Rodney. Thanks for spending your time here today. Stay sharp, stay focused, and I'll see you in the next one. Top 10 mistakes investors make in a cooling market and how to avoid them. Until then, keep learning and keep building.